Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about mortgage rates, housing demand, inventory, and home prices. Logan, welcome back to the podcast.
It is wonderful to be here live in Las Vegas. Just had another Chart Daddy nerd tour, and I believe one of the gentlemen of the board who's been around for 50 years said it was the best economics presentation he's ever seen. So the Chart Daddy hits it out of the park again. But I really want to talk about fantasy football. Sarah, how's your football team doing?
Oh my gosh, it's terrible. It's because I was so busy over the weekend. No, really, I was so busy planning the IMB Summit, getting all the last details, which went off wonderfully yesterday. I did not update my roster. So yes, I had people on bye. I had people who were hurt. It was bad.
So you're 1-3 and I'm 4-0, and I don't even have Christian McCaffrey this year, and it's leading the league in scoring. So yeah. So we're good to go.
And you only joined our football league, our fantasy football league, just to beat me. Yeah. Like that's what your whole goal was.
Yeah, it is. Yeah. And it's working to perfection.
That's terrible. Well, yes, you're at the credit union event, which is awesome in Las Vegas. We just had our IMB yesterday here in Dallas. Both things went very well. So it's exciting. Well, let's get to the topic for this episode, which is definitely like we've got that jobs report coming up. What do you think mortgage rates are going to do?
Okay, so this is Wednesday morning that we're talking, and the ADP report, which is the least important jobs report out there, had a big beat, and the job openings data itself was soft. The internals of the report when it came out, the headline actually beat up, but if you can see the hires and quits, it's decelerating. So what's happened is the 10-year yield went down on the job openings report, the 10-year yield went up on the ADP report. We're still stuck in that 370 to 380 range, but hopefully by now, we've made the case that the 10-year yield had gone a lot lower than the kind of the first level that was going to put up a big fight, the hoarder line. So to get to the next stage lower on mortgage rates, to get below 5.75, because that was the low forecast of the year, you're going to need more material weakness in the labor data. So bond yields have risen up since the morning of the Fed rate cut because housing starts speed and some of the economic data was getting better. So right now, I think we made the case for that. And I know a lot of people are talking about that. Have we seen the lows of the year? Well, if economic data starts to firm up, the spreads are the only way you can get mortgage rates lower. So in that context, I think with Jobs Friday, it's going to be a very good test case on what does the bond market do regards to this in terms of how are we going to act if it's a weak report, how are we going to act if it's a strong report, because we're just bouncing back and forth in a very tight range right now. And I think a lot of people just thought, well, if the Fed cuts half a basis, mortgage rates will be in the mid fives, and they just went the other way. And I think it's a good discussion to discuss because paper, rock, scissors, labor over inflation, right? It works both ways, down and up, because the Fed policy is still very tight in this regard. I think it'll be a good first test case with the Fed. Powell talked, Bostic talked, Barkin, a lot of Fed presidents are talking. And if jobless claims stay low and the headline jobs data stays firm, then, we kind of hit the low point for mortgage rates unless the spreads get better. So I think this is going to be very, very critical for us to see how the bond markets react. Because when the 10-year yield's at 470, it's different. When the 10-year yield got down to 360, a lot has changed. That's what I want to see, how the bond market reacts to whatever report we have, get a little digestion, because right now we're just kind of just bouncing back and forth in a very small, tight range, and mortgage volatility is very little right now.
Okay, so when you think about it, what do you think we're going to see on Friday?
Well, I think the trend is lower. The job openings trend in terms of quits percentage and hires is lower. So we continue. You can have reports where are bigger than normal or lower than normal, but the downtrend is here. So to me, I don't think the Fed is comfortable with 100,000 jobs per month. I think 140 to 165,000, the levels that we've been talking about, that we were waiting for it to show up into the data line, they'll be fine with that. Anything above that is gravy for them.
And that you
So
mean that number of jobs lost? What are you
no,
talking about?
jobs gained. These
Okay.
are all job gains. If it's jobs lost, it's a whole different story. But 140 to 165,000 per month, the Fed is completely fine. They'll just, get you down to neutral at some point. But if it starts breaking under 100, because of the quits ratios and hires are deteriorating, especially in the private sector. But on the other hand, is now that you have lower mortgage rates and the builders are feeling more confident, maybe you get a little bit more upkick in construction jobs. I know that happened last month, so I think that's going to be the key. The trend is always going one way right now, but when does that stop, right? Because if it doesn't stop, you're going negative. If it goes negative, then we have a whole different story. The Feds are going to have to come out and say, okay, neutral isn't good enough. Where are we going to an accommodative stance? That means mortgage rates can go lower. That's your low 5%, sub 5% mortgage market.
Boy, I would wish it for our industry, but let's talk about purchase apps because there is a really interesting purchase app story going on.
Sarah, what is one talking point we've had for 4 years, you and I together? The inability for people to read purchase application data.
Yes.
And here is year 3. And the trolling, goofy accounts running around saying, oh, there's no response. There's no response to lower mortgage rates. So we're going to talk about that. When mortgage rates were going to 7.5%, we had 14 negative prints, 2 positive prints, 2 flat prints, no positive year-over-year data. Since mortgage rates have been going lower, we've had 6 straight weeks of positive data. We've had 12 of the last 17 weeks be positive data. We've had back-to-back positive year-over-year data. Today's report, 9% year-over-year. Remember, the comps are very low, but still positive. Reading is a good thing. Don't have to be a rocket scientist. Don't even have to pass the second grade. But when one is highly negative and the other is highly positive, you don't have to be a coherent human being to figure out that's a change. Right. I mean, some of these people drunk in Las Vegas, I could ask them, has purchase application data changes? Or yes, it has. And then everyone else online, no, it hasn't. Nothing's happened. So I've always said if you had 12 weeks of positive data, depending on how long the period is, 12 out of 17 weeks, okay, that's material. And in the tracker data, we could see it in our pending contracts. So what we're seeing is that purchase application data is getting better. Pending contracts is getting better. In a seasonal down period, we're actually seeing an upstreak, which shouldn't happen. But now you could connect the dots here. So I say stabilization and firming, right? But it made a difference. And if you're not saying it didn't make a difference, then your bias. What do we think about the anti-central bank men in this country? They are going to their graves being bearish American people, right? So if you can't comprehend that is a difference, a second grader can't. So I think it's positive that mortgage rates not even below 6% created this. Because imagine if, hypothetical, just saying, if mortgage rates were between 4 to 6%, where the builders are doing, builders have been growing sales since the lows of 2022, but they live in a sub 6% mortgage market world. So if you get this type of change, and this is 2 of the last 3 years, we've got down to the low 6s at the end of 2022 and the end of 2024. Both times now have created
2023,
12,
right?
Yeah. No, this year. Kind of so the midpoint of 2024. This is a non-seasonal time frame for purchase apps. So we've had 12 weeks back at the end of 2022 going into 2023. We've had the middle of 2024 12 weeks. We didn't get that last year, but we never got down towards 6%. We got, I think, 6.63. We only had 8 weeks of positive data. So here it is. This is all still above 6%. If you get sub 6% mortgage rates and it stays there, doesn't go back up, you got something. You could connect the dots with the data. So I think it's my job is just to, part of the tracker is to guide people with data that you're not going to see. Like our stuff is so ahead of the existing home sales report, you're not going to see it till months out. But we can connect lower rates, purchase apps, pending contracts, the price cut percentage is cooling down. Put it all together, there it is. And if you're still in the camp that there's no material change, you're not that bright. Sorry to say, you're just not that bright of a person, because when mortgage rates were going to 7.5, literally very negative weekly data. There was not a lot of volume on the downside, of course, but having 14 negative prints and 2 positive prints and only 2 flat prints, it really shows the difference. So I'm encouraged. It's just that this is still not a seasonal time frame for purchase apps, but when you get toward the middle of November and the end of December, you can start that seasonal curve. So if hypothetical only, if mortgage rates can make kind of like a 0.5%, something like that, lower during that period of time with this, we'll be able to see it in our tracker data before anyone else does. So it's exciting, right? But I just want to tell everyone, for everyone that's listening who sat there for the last 10 weeks and said nothing's happening, the inability of you guys to not be able to read this data line, there's no excuse. This is year 3 now, okay? Stop looking at the headline volumes, read the internals of the data, right? This is all those people in 2022 that were talking about recession, housing, and then literally 12 weeks of data got better, and we're like, how many videos did we make? We made like 5 videos back then. We're like, the forward-looking data is getting better. Nobody cares. And we're doing it again. And I just think there's just a group of men in this country who just wake up in their life and just hate everything. And they're just going to, so it's encouraging. But I say stabilization and firming. This is not like the V-shaped recovery in COVID. Right. That was 3% mortgage rates. Affordability is much better. So you're still stuck in the realm of affordability issues, but it is positive to see that just getting down to 6% reverse the negative curve to a positive curve.
So let's talk about home prices. So, we're talking about the fact that we are seeing somewhat, mortgage rates are down from where they were this time last year. Obviously, we have, potentially more inventory than we had last year. Give us a sense of where you think, where we are in inventory and where you think home prices are going.
So I just wanted to add that I am still waiting for the cowards who are supposed to give me their 2024 price forecast. It's October. I still haven't got anything because y'all are cowards and frauds. That's what it is. I just want to let everyone know who's a coward and a fraud. I am now at risk of being wrong with home prices. I might be too low.
Okay, so tell us what your forecast was and tell us where we are.
Yeah, my forecast was averaging out would be about a 2.33% nominal home price gains, which the equivalence of rent means negative real home prices, but it's a very small amount of gains. I was looking like I can get there, because we were running at 5-6% home price growth. And we talked about this like 5 months ago, that the growth rate of pricing is going to cool down, especially in the second half. But what we're seeing early on is pricing firming up in the seasonal downtrend, even with inventory where it is right now. So just as a good test case for everyone right there. You can have rising inventory and rising prices. The amateurs, the rookie boys, right, always say that prices have to fall when inventory rise. We look at the history of home prices going back to 1942. We have decades and decades and decades of information that says that is not true.
Okay, so explain that a little bit, because to me that is the common sense thing. Like if there's more supply, then prices go down. If there's less supply, prices go up.
Unless it's monthly supply. And even with monthly supply, there have been periods and times where we've had 5, 6, 7 months of monthly supply with no price declines in the existing home sales market.
So
Now,
what
there's
how is that possible?
because if you look at the history of home prices going back to 1942, this is why the chart daddy nerd tour is really fun. Because everybody looks at when I put those charts up, people go, "What? I didn't know this." 2007 to 2011, a once in a lifetime event. Stressed sellers. Monthly supply was high, stressed sellers were high. We go to 1975 to 1989, right? Home prices were accelerating in the late 70s, faster than what we saw recently here. And then home sales crashed and inventory was rising. Total active inventory was rising. Total monthly supply was picking up a little bit, but total demand was picking up.
Okay.
So you can have rising sales, rising inventory, even rising monthlies. Oh, wait a second, that's 2024. Currently, this is what's happening because right now there's nothing going on with existing home sales. We're basically flat to maybe slightly positive or slightly negative this year. But monthly supply is rising, inventory is rising nationally, but home prices are rising. We literally have this test case right in front of us. Now, I thought I would be correct. The growth rate will slow down, but just recently, the week to week data is firming up. So it might be a 3 to 4% price growth year for the total nation if this continues. But I was like, okay, I can get this. But as we can see, it's just going to be a very, very small home price growth year nationally. And if you adjust it to inflation, the equivalent to rent, it's going to be negative. So really not much is happening. But I am pleased. I'm not like one of these scared guys who like inventory goes, oh my God, home prices are going to crash. We're all going to, And hopefully by now, with the amount of inventory that's picked up, and the monthly supply picked up, we're not quite, you don't have to worry about big national home price crashes. But what we wanted to see happen, what I loved about 2024 is that inventory is picking up. We're starting to get somewhat of a normal market because we can't live off of 10, 20, 15% home price growth years. That's you're just killing affordability and it makes it harder to grow sales in the future. But now it's the sweet spot. I mean, I love it that 2024 is going to be the sweet spot year of all the years. 2020 hated, 2021 hated, 2022 hated, 2023 hated, but 2024 equilibrium, balance, right? And that's the key. And because this is happening so fast and it's in the early data, is that any of the existing home sales pending, all these things are kind of lagging now. So we'll see how the next 3 months go, but I was looking like I'd be right, but now with pricing firming up, I might be a little bit too low on the home price forecast this year. And remember, I do one price forecast a year, and because we track everything weekly, we just keep going off of that, give everyone a heads up. Early on, price growth was way too hot for my correction to be right, or my call to be right. But as rates kept on going higher and inventory picked up price cut percentages, but now price cut percentages is slowing, and we're looking like a negative. For those that read the tracker, it does look like we're going to be heading down lower sooner than the last 2 years. And what's a big difference? Last year was 8%. We had higher rates 2 years ago. So the slope of the curve is just going to be a little bit differently because now demand is picking up.
Right.
See, you see how this whole equilibrium works? How the
I do,
tracker is designed?
but I have questions. I have questions, okay? And they're all around inventory because to me, inventory can be confusing. We have the NAR, the way they talk about inventory. We have the Altos data, which is, fresh data, and we can look week to week. And then you're talking about the monthly supply, and I just want you to clarify that because I think it can be confusing.
So there's the total active listings, like the NAR data. Right now it's 1.135. Normally it's 2 to 2.5 million. So the
Okay.
active listings is still historically low. Okay. We've had, I'll give you the early 1980s. The reason I like using the 1980s so much is because you could really connect the dots here. In the early 1980s, we had more active listings. affordability was worse, home sales were low, we had a recession. But as mortgage rates started to fall, demand started to pick up. And so did active inventory. In fact, active inventory back then got to 3 million in the mid 1980s, and home prices were rising during that whole time. So you can have active inventory as long as sales are rising. There you go. We don't get that much, past 2010, past the QM laws, but there's plenty of history for that. However, where you see pricing weakness is if monthly supply grows, the days on markets grow, and active inventory grows, and demand comes lower. Because that means supply is growing, monthly supply is growing. It takes longer to sell. You have a lot more homes. So sellers might say, okay, I need to cut here, cut here, cut here. And there, if it's a trend, then you can have home prices decline. But here this year, we were still working from very low levels. So if demand is stable, right? What do we always say? After November 9th, 2022, everything changed because demand was no longer crashing. In 2022, we had price declines in the second half, but we were starting at 17 to 19% home price growth year, that early part of the year. So from that peak level, we declined. But as total, even 2022 didn't have home price declines for the full year. So it's a little bit different now. It's stable demand, it's supply rising, and just recently, as mortgage rates have fallen, that's how we look at the weekly tracker. This is why we think that we have the best way of tracking housing data in America. We're months ahead of everyone else, but we connect the 10-year yield, mortgage rates, new listings data, price cut percent, everything that people are not equipped or used to tracking. And then the NAR comes with their reports and say, this is the monthly supply, this is this. So price growth is cooling down in the second half, but just this last few weeks, you're starting to see a change. And it's going to be months before you see it in the report. This is why we stress our data over everyone else, because we don't want to be old and slow, right? We don't want to be the person that, in June of 2023, what happened to my 20% home price crash? Remember all those people making stuff up? Just throwing up 10, 15%, home prices down 20%, whatever. You're not a housing analyst. Get your weak game out of here. Come on now. You're just guessing. So this way, you can see it. You could be it live. And by the time the report comes months later, you're like, we're already here, homie. We don't, too slow.
Too slow. No, I love the tracker. You do that every Saturday. Sometimes we publish on Sunday, depending on when we get the data. When I have time to edit it, when, you're always on the case, but sometimes it's me. But every weekend we publish that. And I think it's so important, especially at this time of the year, to see what is the year going to end up like? What does this last season do? Because sometimes the last couple of years, falls have been okay.
Falls, yeah, and just this one. I mean, imagine if you don't read the tracker or any of our work, you would have no idea this is happening.
Right.
You literally, there are people out there who still today say there's nothing going on, lower rates. I mean, lower rates already changed the new home sales sector 3-4 months ago. I mean, the forward-looking data were getting much better. Now you're starting to see it in the existing home sales market. So again, we always believe the history of human civilization has taught us those that read have an advantage over those who don't, right? So those who don't are still like, prices are going to fall 10% this year. The pain, the headache of these people, these men daily, day in and day out. What must it be like to wake up living in America, just realizing the world isn't as bad as you think it is?
It's your cross to bear, Logan. And we appreciate you bearing it for all of us. You are famously, you don't want to talk about politics, but I love politics. But there was a point in the vice presidential debate last night that I wanted to ask you about as someone who looks at the data, also as someone who's been a loan officer, because one of the points that was brought up was that one of the reasons housing has gotten so expensive, and I believe they said home prices specifically, was because we had so many illegal immigrants come into the country, and they're buying too many homes. They're taking homes away from people who.
Sarah Wheeler, don't you know that BlackRock is being outbidded by illegal immigrants who are just hopping over and buying homes instantly? Jesus. Did they really say that? Did they really say home prices? Did they really?
Yeah, they did.
They really?
So they did say housing too. So maybe they're saying
can you like a big pile of trash and like dump it on top of another pile of trash. No, that's not how it works. First of all, BlackRock doesn't own any homes. It's Blackstone. Blackstone owns 0.06% of the single family homes in America. But in any case, no, I mean, you can make a rent case. Like if there's a surge of population going into an area and the rental vacancies are X amount of percentage and, it takes, rental vacancies, but it's a minor. My God, there's 336 million people in America, right? It's funny because we talked about this in Las Vegas. I said, nobody wants to blame the millennials. These pesky kids are the highest percentage of home buyers and they get scot-free, So, no, I mean, the context is that Americans, people that have lived here for decades and that families, those are the biggest home buyers or renters out there. But if you want to make a case for rental inflation, rental vacancies, a surge of population, that was COVID. A lot of people just moving from state to state. Nobody wants to say that Californians made life terrible for Texas because they came here with their big bags of money, but it's true. But that's Californians, So home prices really, rents you could make a case, but for home prices, no, they're not like coming over and buying a house right away in 2 weeks. You have to have a job, you have Social Security. I mean, come on.
Well,
So
also,
again, Sarah, politics is garbage. It's been garbage for the last 8 to 12 years.
listen,
I know you love it. I've literally like devoided people from my life that want to talk politics, and I just
but
go,
see,
I
this
just
is the
don't
thing.
care.
Politics is how things get decided that affect everyone's
It,
daily
it,
life.
it is, but you don't. Not everyone has to be a participant in it. Like if I
I
imagine
disagree.
if I would have saw that, I go, what did he say? Home prices? No. So rent inflation, that makes sense. But I mean, think about this: the scale of ownership and renters are Americans. Majority are American citizens. So you're talking about a smaller pool of people. So again, this is what politics is. They do these wedge issues. So if you want to make a rental case, and you could do probably studies of this, and you could connect the dots. But home prices, no,
I think it's
that's just
interesting because so much of the innovation in many spaces, but especially in the mortgage and housing space, comes from people who came from other countries legally. Immigrants who came to Silicon Valley could not buy a house. They didn't have a credit history. Their payments back in wherever they came from didn't count. Their bank accounts were different. And so many of those people are the ones who are like, we're going to make this better. And that's where a lot of our tech comes from. So it's funny that those people who make a lot of money and were here legally had so much trouble buying houses that they're like, we need to get some new things in the system.
so. Let's like this is a good reminder for everybody. Um, to buy a house in America today, you need about $110,000 of income with a down payment, closing costs out there. Okay, people that come to this country illegally that are trying to escape poverty or whatever don't usually make 110,000 right away. Okay,
Right.
so you can rents, yeah, but home prices, no. That's just not how it works. So once you have a job, you pay taxes and everything, yeah, you could get that, but it's poor people coming into the country are not outbidding Wall Street or Southern California. Trust me, nobody's coming here, from Mexico and buying homes in Irvine, California, right off the bat. So just always keep those separate prices. Rents make sense, but home prices, those are home buyers out there. So majority are W paid, salary, income, tax paying, Social Security, Americans, right? If you're going to blame somebody, blame Americans, blame millennials. Stop blaming Wall Street and immigrants. Come on. Why are
So
we always we always look at the smallest percentage of people that buy homes and make them the big villains, right? Because it's easier. You
right.
can't say mom and pop investors are the big villains, right? They're like normal people. And here's I got a good question. Somebody asked me, why don't they give like capital gains tax free for investors and they sell all their properties? And I said, okay, so what are we doing with those families?
Right.
And the person's like, what? So we're kicking a bunch of renters out of their homes. So imagine if you're a politician saying, I'm going to free up all the supply in my city And all of a sudden, you got all these renters getting kicked out of the house, and then they're going into a smaller supply pool. And those landlords are like, oh, come to daddy. Come on. I'm going to raise rent even more because there's not a lot of supply there. So if people are wondering why you've never seen major tax cuts or capital gains tax cuts for investors, there is a concern that if you kick out a bunch of renters and there's less supply, then there's going to be more inflation because rent inflation can pick up in that situation. And it is what it is. But yeah, politics.
Well, I appreciate you weighing in because I know you don't like the issue, but I think it's important to say, like, what does the data show and what does it look like? And then we can get to the real issues. For instance, maybe rent. So, Logan, thank you so much for letting me ask you a political question and giving me an answer.
It's okay. I feel bad for you since you're 1-3 and you won't make the playoffs in the fantasy football league.
Oh my gosh. I don't even have anything to say. I'm going to try this week, okay? I'm going to
Okay,
try.
there you go. Good job. Trying is the best.
All right. Talk to you later.
Yeah.